You've seen it. Demand fails, loss. Supply trade, another loss. Why? Most traders ignore mechanical confluence in supply and demand. In this video, we'll fix that. First, I'll show you how to identify zones. Then, how to draw mechanical supply and demand. And finally, the 8 institutional rules that can change your trade. Miss these, and you'll keep losing for years. Let's begin. So how do we make sure that we are trading on the right side of that institutional order flow? And that's where supply and demand zones come into play. But how do we identify these zones? When price is moving sideways in a range, this is where orders are being accumulated or distributed. As price moves into the bottom half of the range, this is where buyers step in to buy at discount cheap prices. And then as price moves into the top half of the range, sellers step in to short at premium expenses. You want to buy low and sell high, right? Pretty simple. Eventually, aggressive buyers will cause an overwhelming imbalance between supply and demand. And this is where price will rapidly break out of the range to the upside to search for more liquidity to absorb the demand. And this is what creates those demand zones. Now, we don't trade the initial breakout, as this is where losing traders FOMO into long positions and they buy the highs. Instead, we wait for price to return to that zone. And then we look for entry models to get long, as this is where the risk to reward will be. We'll be on our side and we are buying where the institutions will be. Now, why does price return to the zone and then continue from there? Well, at this level, there is not enough demand to keep pushing price higher. So we wait for price to return to the demand zone, where those previous institutional buyers, they will have a vested interest to make sure that price does not trade any lower, and they keep their initial long positions in profit. And it's also likely that they did not get filled on all of their original position. So they will want to get long with their remaining orders at the discounted prices because remember, they're going to want to buy as cheaply as possible. Now, there are some other theories, but we won't get into those in this video. And the exact opposite happens in the creation of supply zones where price is in a range. Sellers will then cause an overwhelming imbalance between supply and demand, as price will rapidly break out to the downside. But again, we will wait for price to pull back to that supply zone to then look for potential shorting opportunities. And it's a 4-step process where we have the range, the initiation, the mitigation, and the continuation. And it's that continuation is what we are looking to trade in line with the institutional order flow. This is the cycle and heartbeat of the market where order flow will continue in one direction until there is an overwhelming imbalance between supply and demand in the opposite direction. Price is constantly seeking liquidity to rebalance price. So how do we draw supply and demand zones in the same way every single time? There are 3 types of supply and demand zones. The first 2 are the ones that I recommend you use. These are range and pivot zones. The names are pretty self-explanatory. A range-created zone is where price clearly initiates out of a range of candles. You draw the zone from the top to the bottom of the range. A pivot zone is where there is a pivot in price caused by only 1 or 2 candles. You can draw this from the single candle that is engulfed, or you can include the second candle too, depending on how refined you want to be. For a supply zone, it's usually a bullish candle, where the next thrust candle closes below its low. This can be called a buy-to-sell zone. For demand, it's usually a bearish candle, where the next thrust candle closes above its high. And this can be called a sell-to-buy zone. Now, I'm not personally that strict on the sell-to-buy or buy-to-sell method, because sometimes I will draw a demand zone on a bullish candle that's then engulfed by another bullish candle and vice versa, because I'm just looking for those pivot points in price. You know, the price is sort of paused and moving sideways, and then price clearly initiates out of the range. But for a demand zone, that thrust candle must close above the previous candle's high. And for a supply zone, the thrust candle must close below the previous candle's low for it to be a valid supply zone. And you can see how a range zone can be refined to a pivot zone, or even a fractal zone, which is just the wick. However, more refinement does lead to increased accuracy, giving you that smaller stop loss, which in turn gives you that higher risk to reward. But it does increase the probability of more missed trades, as price might not tag you into the position once enough orders have been filled. Find a consistent balance that works for you and stick to it so your edge can play out in the long run. You know, don't be chopping and changing just because you feel like it. I recommend that you start with always looking to take the single candle pivot, as this gives the best balance between risk to reward and also getting entered into enough positions. Now, remember that the market is made up of all of those orders transacting with each other, but we make sense of that complicated order flow with our candlestick charts. If you see a range-created zone on one time frame, this will be a pivot zone on a higher time frame. So if you see this range-created zone on, let's say, the 1-hour chart, the zone is made up of 4 candles. But if you go up to the 4-hour chart, what do you think that zone is going to look like? You guessed it, it will be a single candle 4-hour pivot zone, because 4 1-hour candles are going to make up 1 4-hour candle. So when you truly understand the fractal nature of markets, you don't even need to change time frames to be able to visualize what price action will look like on that other time time frame. So that's why a lower time frame range will be a higher time frame pivot zone, and vice versa. Here are three types of fractal supply and demand zones. First is the inside bar, when a candle fails to break the previous candle's high or low and trades inside it. Inside bars represent a range on a lower time frame. Second is the sell to buy or buy to sell wick zones. In a bullish move, price may not form a visible pullback on the current time frame, but the wick shows a pullback on a lower time frame. Price pushes up, pulls back slightly as the next candle forms, then continues upward. On a lower time frame, this appears as a pivot or range demand zone. The opposite applies for buy-to-sell wicks, which represent lower time frame supply. Third is the large wick zone. Instead of marking the entire pivot zone, you can refine it to just the wick, which represents a lower time frame pivot or range zone. These are all fractal refinements, ways to view lower time frame zones on your current time frame. But for now, focus on pivot and range zones within your current time frame, as they hold more orders and offer higher probability moves. Not all supply and demand zones are equal. Specific criteria must be met for a zone to qualify as an institutional supply or demand zone. There are 8 key areas for us to focus on, and the first is whether the zone led to a break of structure. This is the simplest and most effective filter that you can use. It takes a ton of money to break structure on a liquid instrument, and the more significant that the structure breaks, the more significant the zone. Swing structure is stronger than internal, which is stronger than fractal. So zones that cause a break of swing structure, they're going to be the most likely ones to cause the next break of swing structure. Here you can see this demand zone broke the daily swing high, so then when price returns to the zone, there is enough demand within there to break the next swing high. Number 2 is if it is a flip zone. Now the key here is that you must see that interaction between supply and demand until one overpowers the other. Here you can see supply was in control, but when price returns to it, supply tries to make a lower low, but it fails to do its job because huge demand steps into the market to overpower it. That pattern then shows us that supply has now flipped to demand, and this is a high probability area for us to get long. But remember, you must see that interaction first for it to be valid. Number 3 are sweep zones. These are zones where liquidity is swept and taken as they are created. But why is this important? Well, remember, institutions need opposing liquidity for them to trade against, so that they can get minimal slippage when they enter and exit the market. So if they're buying, they need a lot of supply to buy against. There will be a lot of sell orders below this low, and that's generated from people's stop losses from early buyers and then breaking. So if you see a sweep zone, this signals it was created with institutional involvement. Number 4 is inducement, and this is another liquidity concept that can get very technical, but essentially, you just want to see, is there available liquidity in front of the zone? Why? Well, same reason as before. Institutions are going to need that opposing liquidity to enter the market with minimal slippage. Here you can see there is available liquidity behind this low for institutions to use to buy against, but if there isn't any available liquidity, then very often these zones are traps, and they will usually fail. Here you can see that there is absolutely no available liquidity in the leg, so this is a very obvious trap, as institutions will not be selling it. Number 5. Do you have alignment with the higher time frames? The more time frames that you have aligned, the higher probability of that trade here. It might look like a high probability sell to follow the bearish trend on the M5, but the M15 is bullish, and it's just mitigated the M15 demand at the strong M15 low. So now the M5 is likely to also switch bullish. Understanding multi-time frame analysis will help you to avoid a ton of losses, as time is power, and higher time frame will usually win. Number 6. Is the zone unmitigated? It's just a fancy way of saying, is the zone completely fresh, or has it already been touched? Because if you see a zone with touches, then it's very likely that a lot of the resting orders within that zone have already been filled. So I try to focus on zones that are completely fresh, as these usually give the strongest move when price mitigates them. Number 7. Is the zone well priced generally? The highest probable demand zones will be buying in discount prices, which is in the bottom 50% of the range, or selling premium prices in the top 50% of the range. This also improves your risk reward because we want to buy low and sell high, right? And last but not least, number 8. Is the zone stacked with another high time frame zone? The more you can stack zones across time frames, the more orders there should be in that area, increasing the probability of the move. Now combining as many of those confluences together are going to give you the highest probable institutional demand zones to trade from. Now you know the rules. Apply them with discipline and watch your trading transform. See you in the next one.